Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. Consumer inflation falls to below 7% in October for the first time in 3 months, follows the path of wholesale prices, which are also the lowest in 19 months. Raises hopes that the RBI may slow the pace of rate hikes. Traders and investors on Dalal Street prefer to wait and watch for inflation figures. Profit booking in stocks which gained the past few sessions. Sensex and Nifty end in the red. Infosys blows the bugle to bring employees back to office. Second tech major to do so after TCS. Promises a compassionate policy for employees. Modi government fires on all cylinders as tax collections set for a new high this fiscal. Sources tell Business Today TV that direct collections could exceed the budget target by 1.5 lakh crores. Investigations ordered into the affairs of the failed crypto exchange FTX as it emerges that more than $600 million was siphoned off. Analysts say the collapse could be the Lehman Brothers moment of the crypto world. Consumer inflation has fallen to a 3-month low of 6.77%. According to figures released this evening, CPI clocked in below 7% for the first time in 3 months, led by a sharp fall in food inflation, which fell to 7.01% from 8.6% a month ago. This follows a sharp decline in wholesale prices, with WPI at its lowest level in 19 months. The wholesale price index for October fell to 8.39%, breaking an 18-month double-digit streak. What does this mean for the consumer as well as the monetary policy? To understand this, my colleague Siddharth Zarabi talked to PK Basu of ICICI Securities. Let's listen into an excerpt.
Welcome, Prasenjit, to the show. You had some time to digest the latest numbers. We've seen the wholesale price data come in. Tell our viewers, what does this easing in the rate of retail inflation, or what is called the consumer price index inflation, really mean?
Well, what it means is that the pace at which prices are increasing has eased off. So we were seeing inflation above 7% for the last 3 months, and that was definitely a major cause of concern to the RBI, given that the RBI has a mandate to keep inflation in the 2 to 6% range. It is still well above that at 6.77% year-on-year in October, but it is beginning to ease off, and the news is likely to get a bit better going forward, partly because the Kharif harvest is currently underway, and that is likely to have been a very strong harvest, which will help to further moderate food prices. So as food prices come off and food inflation eases, we should get slightly lower inflation going forward. In year-on-year terms, oil and energy inflation is unlikely to be particularly high in the second half of the fiscal year. That is October this year to March next year. We'll see base effects helping on the energy inflation front. We've already seen the impact of that in the latest WPI number. WPI, of course, has a very big weight for fuel, much larger weight for fuel than CPI does. And so we've seen the WPI inflation rate come down to 8.39% after being well in double digits for almost a year. So those are all pieces of good news on the inflation front. The worst is behind us. And we've also seen that in the US, the worst is perhaps behind the US. So a global moderation in inflation is a good thing.
Prasenjit, since you speak about the worst is behind us, what about core inflation? That doesn't seem to have fallen. Should we be concerned about that, or is it time to sort of break open the champagne when it comes to inflation?
Well, in India, we don't look that much at core inflation. And the reason is that food and energy are very important parts of the consumer basket for Indians. You cannot ignore food. And so core inflation is a nice theoretical concept for us, but food inflation is really important. And food inflation has been above 7%. Um, and remains. It has just come close to 7% now in the latest month. And really the key for us is that that needs to come down. Now, if India was like the US and we were targeting core inflation, then the RBI wouldn't have had to send a letter to the government explaining why it has been missing the inflation target, because in terms of core inflation, we were below 6% for several months anyway. So
Sanjay,
it hasn't moderated substantially further.
Okay.
But the point is that it's not, core inflation was not as much of a problem in India as it was, say, in the US relative to the inflation target.
And what about the reversal of the base effect as far as the number goes? At some point, we will see that happen. Will that mean that we could see it building up again from December, January onwards?
Well, actually, the base effects are going to be very helpful from January onwards, because remember, it's really since January that inflation edged above 6%. So as we go forward, January, February, March and beyond, base effects are actually going to be very helpful because this year, calendar year, we've had relatively high inflation. That's one thing. The second is, as I've said, the oil effect is going to be particularly helpful. It's very unlikely that oil prices are going to surge too much above $90 a barrel. They are currently a little bit above $90 a barrel, but it's not going to be too much higher than that going forward, given that global oil demand is coming off as the developed economies go into recession.
The artificial suppression of the retail price push of petrol and diesel to the Indian consumer. In the last several months, if memory serves me right, 6 months at least, the Indian consumer has been protected. Now, I can't exactly plot what would have been the consequences, but if you have given this matter a bit of thought, do you think that by adding natural price changes, our inflation data improvement would not have been so?
Well, I think it's very interesting that you raised that, because we've just had COP27, where the world was meeting to consider what to do about climate change. And I think this government, over the last 8 years, has been really taking the lead globally in ensuring that even when oil prices come down a lot, the full benefits don't flow through to the consumer in India. Because India is a big net importer of oil, and being a big net importer of crude oil, India needs to move away from dependence on fossil fuels. And so what this government has done really quite well, I think, is that it has ensured that the relative price of oil compared to renewables steadily moves in favor of renewables over time. And to do that, they've kept the taxes on the excise duties on oil products relatively high. And as a consequence, there was a little bit of headroom. Last year, at the end of October, there was one cut in the excise duty rates, and then earlier this year, and I think in May or June, we had another cut. So there have been these cuts. In addition, the government has imposed export duties to deter exports of petroleum products. India is a significant exporter, interestingly, of petroleum products. So now there are still some export duties in place to deter exports, and all of that is helping to moderate domestic oil prices.
That was our managing editor, Siddharth Rabi, on the latest inflation figures. The Modi government is on track for a bumper tax collection this year. While the budget had estimated direct tax collections at 14.2 lakh crore rupees, the actual figure could exceed this by 1.5 lakh crore rupees. For more on this, we're joined by my colleague Karishma Asudani. Karishma, yes, take us through all those numbers.
Well, right, Abha, it's very important that we understand on the run-up to union budget, the government is now checking its budgetary estimates of financial year 2023 in order to prepare for 2024, and looks like it's going to be good news for direct tax collections, because we are picking up from our finance ministry sources that direct tax collections could go up by 1.5 lakh crore in compared to the budget estimates that it had put. In fact, in a recent press release, government also announced that they've already achieved about net collections minus refunds close to 9 lakh crore. So from a total of 14 lakh crore, about 60% has been, of course, fulfilled as per the estimates, and looks like government is confident that it will cross beyond the 14 lakh crore by the end of the year. Good news, because somewhere, I think, wrong to say, but somewhere inflation has contributed to these good tax numbers for Government of India.
All right, Karishma, countdown to budget really has begun in earnest. Trade remained muted today as investors prefer to wait for consumer inflation figures released after market close this evening. There is hope that a fall to below 7% will slow the pace of interest rate hikes by the central bank. Action was limited to specific stocks, mainly on account of their results. While the Sensex dropped 171 points to close at 61,624, Nifty was down about 20-odd points today. Top gainers, Hindalco, Apollo Hospitals, Tata Motors, Grasim and Kotak Mahindra Bank. On the losers end, Dr. Reddy's, ITC, Coal India, Hindustan Unilever and State Bank of India topped the list. So what are some of the market triggers this week? I earlier spoke with our global business editor Udayan Mukherjee for his take. Udayan, markets today volatile but ending pretty much flat. What cues should we now take from here on? Are we awaiting some kind of signal from what's happening in the US, or do we continue to ride on the domestic growth story?
Hi, Abha. I think it's going to be global from here, because the earnings season is pretty much over and it's been a mixed bag. So I think there is not too much by way of domestic cues. But I think the cues from the global scene are very powerful, because as you would know, the recent inflation print in the US was much lower than expected, or somewhat lower than expected, and that's sort of led to a lot of excitement in the Western world on whether the Fed will soon stop or at least ease the pace of rate increases. This has resulted in some kind of declining in the dollar index and has sparked off a risk-on rally in global markets. And we've benefited from that as well. There's been some buying from FIIs because of that too. So I think that this leg of the rally, which has taken the Nifty to about 18,300, has been fairly global in nature, because I don't think we've got, other than the financial space, the banking space, that is great triggers from the earnings calendar. I think we'll have to watch the global space very, very closely. Closer home, I think the market internals are looking very interesting, because of the return of the global money, we've seen a bit of a rotation in the large caps. Some of these earlier winners, like the ITCs of the world, have seen some profit taking, while the HDFC twins were the stars of the week gone by. I mean, they've rallied after a long time, and the rallies have been quite significant too. But I think what is interesting, Abha, is that the mid caps and small caps are not doing as well as the large caps at this point. It could be because global money is back and the local crowd is feeling slightly hesitant at these elevated levels for the market. So the small caps particularly, and even the mid caps, have actually not kept pace with the large caps in this leg of the rally, and we'll have to watch that and monitor that quite closely. Finally, on the global aspect, I would point out one important thing, which is that global volatility has fallen off very significantly. If you look at the CBOE VIX in the US, that's down to about 22 kind of levels right now. The peaks are about 35 and 36. But usually the VIX, which moves in the opposite direction of the market, tends to bottom out, or has bottomed out in the past around 20, which is when markets start to fall and volatility starts to rise once again. So we are within skirting distance of medium-term lows for the VIX, and I would be a little watchful on that front before getting carried away. So I think keep your eyes on the global ball. That is, I think, what drives us in the last few weeks of the year.
Infosys is the latest IT major to ask employees to return to office for work. According to internal communications accessed by Business Today TV, the IT bellwether is adopting a three-phase work-from-office plan. TCS, India's largest IT services company and one of Infosys' competitors, has already started a hybrid model to bring back employees in offices in a phased approach. For more information, we have with us our IT sector reporter, Akanksha Chaturvedi. Akanksha, what's the new Infy policy and how will this be implemented?
Well, as per an internal communication released by Infosys, the company is soon going to reinstate work from office, but this would happen in a three-step plan. So the company employs a little over 3 lakh people, and all these people would have to start working from office as per the plan released by Infosys. So the first step would be all employees would be expected to come to office 2 days every week, which means every 2 days they would have to report from office. The next step of this plan would be employees would have the option to choose any branch they wish to work from. They could get a transfer or a relocation. Interestingly, Infosys actually has 247 branches which are spread across 54 countries. So this would be interesting how this pans out logistically. And the last step would be to build the work from office or the hybrid work policy. So Infosys is planning that it's going to draw feedback from the first 2 phases, and that's how they're going to build on their work from office or the hybrid work policy.
But the core question is, are IT employees willing to return, Akanksha, and how are some of these major tech companies managing this change in employee attitude?
Yeah, well, you're right, Abha. There's a lot of resistance from, employees. People don't really want to work from office now. Work from home is more convenient. It's more comfortable. People don't have to waste a lot of time in commute. It saves time, energy, and money. But the thing is, the companies are more focused on providing employees flexibility. That's at the core of Infosys' new policy. Even the CEO, Salil Parekh, as well as the head of HR, he also mentioned in the email which we were talking about that the company wants to provide flexibility to its employees. They don't want to reduce the flexibility. They want it to be convenient for the employees, but working from office is also important, to cater to their clients' needs. And so maybe employees are not that resistant to this policy. A similar phased manner of work from office policy was also reinstated by TCS. They called it the 25-25-25 policy, where only 25% of the employees have to be in office 25% of the time. And this way, they tried to roll back work from office after, the COVID-19 pandemic. So it's going to be interesting to see how other companies are going to, create their own version of, or, how they're going to try to lure employees back to office. So over to you, Abha.
Thank you for that, Akanksha. Let's take a look at what else is making news in the corporate world today. Days after his arrest in the Delhi liquor scam, Aurobindo Pharma has relieved its whole-time director, Sarath Chandra Reddy, of his duties. The board of India's second-largest pharma firm met over the weekend and relieved Reddy because of his temporary inability to perform executive functions. Shares of Life Insurance Corporation climbed 5.8% today after the life insurer reported a multiple jump in the September quarter profit. The country's largest insurance company reported a net profit of 15,952 crore rupees for the quarter, compared with 1,433 crore rupees in the same period last year. Paytm has more than doubled its loans in October, with their rupee value rising nearly 5 times. The company also pushed its offline payments business in October, taking the total number of devices enabling payments without internet to more than 50 lakhs. Elon Musk, the world's richest man and CEO of 5 companies, said he has too much work. Not surprising, but he did say this at the G20 summit that's currently going on in Bali. He said that ever since he bought Twitter, he's been working morning till night. Here's a report by my colleague Rachna Dhanrajani.
Ever since Elon Musk set his eyes on Twitter, he has been making headlines every day. First came a legal battle before the Twitter deal was finalized, and then the mass axing of employees after the takeover. He's the world's richest man. Speaking at the G20 summit on Monday, he said ever since he bought Twitter, he has been working from morning till night, 7 days a week.
I mean, I'm really working at the absolute most amount that I can work from morning till night, 7 days a week. So this is not something I'd recommend, frankly.
Along with Twitter, Musk is also the top boss of his EV company, Tesla, his neurotech company, Neuralink, his ambitious spacecraft company, SpaceX, along with his tunnel construction company, The Boring Company. Musk, who has been described as the nano manager, has been at the helm of Twitter for over 2 weeks. And in this time, he has not only fired the top executives and become the CEO, he is also the sole director of the company now. Musk, as a part of his ambitious revamp plan for the company, rolled out a new Twitter Blue subscription last week, shortly before suspending it. The new Twitter caused chaos on the social media website as impersonators quickly emerged as verified accounts, leading to widespread chain reaction of fake messages. So as of now, the new Twitter Blue that was seen as major revenue generator remains suspended. Meanwhile, in these 2 weeks, Musk has also laid off close to 50% of Twitter staff globally and has warned other employees of a possible bankruptcy. Meanwhile, Tesla shares also took a hit last week as Musk sold another batch of his share to fund his ambitious Twitter plans. Clearly, the world's richest man has a lot on his plate. With Rachana Dhanrajani, India Today Television.
The U.S. government is all set to begin a formal probe into the dramatic collapse of crypto exchange FTX. This after the Bahamas Police Department announced its own probe into the collapse, being described as the Lehman Brothers moment for the crypto industry. Meanwhile, the CEO of Binance, the company which catalyzed the collapse, has sought to calm the industry in turmoil.
Changpeng Zhao, the CEO of Binance, who first offered to buy out FTX last week and then rescinded the offer, has broken his silence. Zhao's U-turn precipitated the biggest collapse in crypto space, bringing FTX, the largest crypto exchange in the world, down like 9 pins.
We do need to increase the clarity of regulations and the sophistication of regulations in the crypto space. So much turmoil in our industry, but I want everybody to understand that's not reflective of everything in the industry. The industry goes through ups and downs. We have one or maybe even more bad players in the industry, but the industry is still growing, so we're still building.
The elusive Sam Bankman-Fried, the 30-year-old founder of FTX, is meanwhile repeatedly apologizing. In a series of tweets, the crypto CEO, whose net worth evaporated to $1 from $16 billion in just a week, has been tweeting his apology and reassuring customers. This comes even as government investigators in Bahamas, where Bankman-Fried lives, started a probe into whether any criminal misconduct was involved in the FTX collapse. There are also reports of lawmakers in the US beginning a probe into the debacles, especially with allegations of unauthorized transactions. Analysts have flagged as much as $600 million in assets being moved out in suspicious circumstances. FTX has already seen $1 billion in customer funds vanish, with the platform's token plunging in value. Many are comparing the exchange's bankruptcy on the 11th of November to the collapse of Lehman Brothers, along with skepticism that there will be prosecutions.
It is going to be something like a Lehman Brothers because FTX.com just didn't have individual investors as their clients. They had other brokerage firms, hedge funds, trading shops, venture capitalists, institutional investors, and even crypto miners and crypto validators as customers that held funds with their brokerage operation.
There's been a lot of conversation about the fact that we didn't see bankers prosecuted in the 2008 financial crisis. And I think in this case, the crimes are even clearer in a lot of cases. But it does raise that interesting question. Why weren't bankers put in jail? in 2008. And for this industry, where clearly a lot of people belong in jail, will they be prosecuted is a very interesting question, and I sure hope the answer is yes.
Bankruptcy documents filed by Bankman-Fried showed FTX had $13.86 billion in liabilities and $14.6 billion in assets. However, only $900 million of those assets were liquid, leading to the crash crunch that ended with the company filing for bankruptcy. The contagion hit the entire crypto sector, with the Bitcoin falling to below $16,000 for the first time since 2020. Bureau Report, Business Today TV.
And that's where we close it in the ever-exciting world of business tonight. Thanks so much for watching.